I know I bring you a lot of doom and gloom, but today we're going to change that. We're going to talk about a record $4 trillion in corporate debt and why it isn't all that scary. And then I'm going to bring you an indicator that's 90% accurate and suggests hidden strength in the stock market. So today, there's nothing but blue sky. Let's take a look. U.S. corporations have about $4 trillion in debt maturing over the next 5 years. However, the ability of U.S. corporations to deal with the higher interest rates isn't as alarming as the headlines may appear. This, according to Sean Darby, who's the chief global equity strategist at Jefferies. He asserts that U.S. companies' ability to cover payments remains healthy thanks to decent cash flow and corporate pricing power. The U.S. companies generate decent forward free cash flow, although admittedly it is close to historic lows, but enough to create a comfortable buffer over U.S. Treasuries, Darby writes. According to Jefferies, the S&P 500, excluding financials, forward free cash flow yield is just above 5% or more than 2 percentage points above the U.S. 10-year Treasury yield, which has hovered around 3% in the past few weeks or so. With the economy and inflation stepping into higher gear, there is every expectation for interest rates to rise further. Higher rates means higher borrowing costs as well as higher debt servicing costs that will eventually eat into earnings. However, this again is according to Jefferies. And if you've seen my few videos on bonds, you will know that I don't necessarily believe in higher inflation or higher interest rates. But let's continue here. So Darby states that while net debt to equity among the S&P 500 non-financial companies has risen to alarming levels since the great financial crisis, the distribution suggests that much of that has to do with business models of companies. Operationally geared businesses, in other words, high asset turnover businesses, can use financial leverage to their advantage to improve profitability, Darby again wrote. In this chart here, you can see that the bulk of the S&P 500 companies have net debt to EBITDA well below 6, and EBITDA means earnings before interest, taxes, depreciation, and amortization. Again, EBITDA. And this ratio is commonly used by credit rating agency firms to see if a company is likely to default on its debt, and usually anything above 5 is considered too high, though the ratio varies between industries. And profitability of U.S. large cap companies continues to be relatively good, especially in the wake of recent corporate tax cuts. With the first quarter earnings season almost done, the S&P 500 net margin was at a record 9.73, according to FactSet. According to Jefferies, not only are the companies profitable and generating enough cash flow to cover interest expenses, they're also able to offload rising producer prices to consumers, which pushes real borrowing costs lower. And in this chart here, Darby shows that prices have been rising in manufacturing and services, while final goods prices are rising alongside higher interest rates. Now, while the gearing of the S&P 500 has risen, debt servicing ratios have remained healthy, while credit solvency is also generally good. The S&P 500 companies are enjoying a so-called renaissance of pricing power that is helping to improve financial performance and keep real borrowing costs low. Now, do I subscribe to this theory? No, not necessarily, but I'm just not trying to be a downer. I'm trying to bring you some information from a reputable agency, Jefferies, which is trying to show you that maybe there is some blue sky out there. But for me, I see the clouds and not necessarily the blue sky. So is the glass half full or half empty? But let's go on. Stick with me. Although the U.S. stock market may feel particularly risky right now, things may not be as bad as they seem. There are multiple signs of equity strength going on below the surface of the major indexes, which could be a sign that the recent uptrend in stocks is justified and could continue. And one positive sign looks at the ratio of rising stocks on the New York Stock Exchange to the number of falling ones. Paul Schatz, the president of Heritage Capital, referred to this as the one indicator that's 90% accurate for forecasting moves. And currently, the NYSE's advanced decline line is at an all-time high. And as seen as this chart here, when the major stock market indices make new highs, but the NYSE advanced decline line does not, that's where the bulls should begin to worry. And Schatz added that the exact opposite is happening. And he says that this is typically a good sign for further strength in the stocks over the medium term. The improving advanced decline line is an encouraging signal for the investors who have been worried about market breadth, especially as some of the market's biggest names, such as the FANG stocks, have been leading the overall advance. Because the market's biggest companies have been seeing the biggest gains, those leaders can mask weakness in smaller companies. And Schatz compared it to a building where the foundation is full of cracks and is crumbling, but the penthouse looks flawless with million-dollar art and furniture. And the improving breadth is helping to support equities, which can be seen in the broader indexes themselves. And the Dow Jones Industrial Average, for example, is coming off 6 straight positive sessions, while the NASDAQ Composite is coming off 5 straight gains. And the CBOE Volatility Index is on track for its 5th straight weekly decline, a sign that volatility is leaving the market. Both the Dow and the S&P 500 have shown signs of maintaining their long-term positive momentum. Both broke below their 200-day moving averages on an intraday basis last week, but they subsequently rebounded to close above it each time. Ending below that level is seen as a bearish signal, but holding above it is a sign of support. Since testing the level, the Dow and the S&P have returned above their 50-day moving averages. And again, this isn't simply a matter of the market's biggest names leading the overall indexes higher. According to stock charts, 61% of the S&P's components are now above their 200-day moving average, so up from 50% about a week ago, and back above the 59.55% average over the past 50 sessions. Ari Wald, head of technical analysis at Oppenheimer, added that the number of net new lows had been dropping, a trend that suggested that selling in stocks is getting less bad, or things are improving. And he added that this means we've been holding up well in periods of consolidation and that the market has been finding a base. And this is setting us up for the next move higher in the bull market, things that we've been talking about for the last couple of weeks. So these guys are a little bit late. So then the question, where do we go from here? Well, I suggest subscribing to this channel and also paying attention to my weekly updates. So for today, that's ChewDog Charts. Thank you.